Joining us now for more on Tesla, Toni Sacconaghi, Bernstein Senior Research Analyst. Toni, great to have you with us. You're basically the opposite of Cathie Wood. You've got an underperform rating, a $150 price target. And I think that was interesting when I read through your notes is that, you have all these estimates. You think full year 24 estimates on the street are too high, but it almost doesn't matter because if you take a look at how Tesla has reported and how they have missed estimates in terms of deliveries for a number of quarters, they've missed on some of the metrics for the quarters. The stock is still up 80% this year. So how do you look at this stock right now and say it's 150 when it's divorced a little bit from these estimates and the expectations on the street?
Sure. Good morning, Melissa. Yes, I mean, I think in the near term, Tesla stock has been extremely difficult to call. As you know, I think earnings estimates for this year have gone from $6 to $3, and yet the stock is almost double from the beginning of the year, albeit still down considerably from, last September, October levels. And so I think that's very challenging for investors when numbers are generally coming down and the stock is holding in there or actually gaining ground. I think a lot of it is because there's continued belief in the longer term vision of Elon Musk and Tesla. I think he showed the clip of Cathie Wood saying she really believes in autonomy. Others have espoused the fact that Tesla will have dominant market share 10, 15 years from now, 10, 20 million cars. And so I think while that hope is still possible and is still alive, it's difficult for the stock to go down. I think the big question for me is next year, do they have to cut their growth targets? Might they only grow at 10%? And I think it's certainly possible in 24 and 25 that Tesla could have pretty modest unit growth because they're not going to have new models, and they're struggling to grow now without doing major price cuts.
I want to talk to you about China, since that's supposed to be a major engine for the Tesla story in the future. Li Auto, a competitor there, has been gaining market share. Granted, it's only 4.5% according to its latest earnings report, but that's up from 1.5% a year ago. Tesla has been losing a little bit of share. HSBC, in its initiation last week with the sell rating, pointed out that the EU might be looking into probes. And so that could impact, it exports 40% of the cars made in Shanghai right now. How do you take a look at the China story? And is there, if it was worth X amount in its share price, 8 months ago or a year ago, what is it worth today? Is there a discount associated with that?
I think, the Chinese EV market is incredibly competitive. It's, 1 out of every 3 cars sold in China this year are EVs. There is an 800-pound gorilla, BYD in China, who is growing much faster than Tesla. They just reported 25% automotive gross margins. Tesla's at 17%. They only make EV-related cars. And, there are others like Li and Xpeng who are formidable competitors as well. And so the Chinese market, which is the largest car market in the world, is the most competitive market. It has the most models, it has the most competition, and Tesla has its lowest share there of any region. Its share in China of the EV market is about 10%. Its share of the EV market in the US is about 70%. And I think over time, markets will become more competitive. The European market will become more competitive, is becoming more competitive, as the Europeans have come out with pretty good EVs and the Chinese are moving in. And I think over time, the US market will become more competitive. And that's the challenge for Tesla is it's playing in a hyper competitive marketplace. And it's really, really difficult for one player to have outsized share or profitability. And that's ultimately our concern about Tesla longer term, is that it is really a car company, and the car industry makes it difficult for anyone to have outsized margins or share over the long term.